Gray skies are in. It's chilly with a chance of wet snow and sleet developing this afternoon. Rapidly changing to rain. There could be a small accumulation. Temperatures around 36. And then overnight, rain ending, breaking clouds, temperatures falling slightly above freezing. And for tomorrow, a mild day with a mixture of sun and clouds. It'll be near 50. Thursday, cloudy, chance of more rain during the afternoon. It'll be mild. Temperatures mainly in the 40s. That's my forecast. I'm Marc Rosenthal.
I'm Ed Evans, CEO of Consumer Cellular. You know, the big wireless companies say they have discounts for people over 55, but unless you're willing to sit on hold and ask, you're probably paying more than you should. At Consumer Cellular, there's nothing to hunt down. We're built for people 50 plus with plans starting at just $20. And our 100% US-based customer service actually answers the phone. Call 1-888-FREEDOM or visit consumercellular.com today and get your second month free for a limited time.
Taxes, fees, and other third-party charges will apply. See website for additional details.
You're tuned in to Money Matters Boston, 1120 AM WBNW. This is WBNW, 1120 AM, the Money Matters Radio Network. This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston, the Money Matters Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
As a busy mom, my to-do list is full.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has information to help you and your family live a healthier life.
Visit goredforwomen.org/momlife today.
As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be funded, it's important to have a clear plan for how all of your upcoming costs will be handled over time. Divorce also means adjusting to a new financial reality, where one household becomes two and your budget, saving strategy, and long-term goals may need to be reevaluated. Our new guide is called Divorce in Your Financial Plan, and it discusses ways to build a financial strategy that supports your family's next chapter. You can get your free guide today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about the use of life estates and your primary residence. Todd, what are the pitfalls associated with creating a life estate when you transfer the remainder interest to your children?
Yeah, this is the most common way people create life estates. It seems easy, it seems simple, but it's not the best way to create a life estate. Once you put your children's name on the deed, you give up a lot of control. Like you can't change your mind later if you want to leave it to one child versus another who might be taking care of you later. You have problems if you want to go to sell it, right? You might have the right to live there, but if you want to go to sell it, you're going to need the permission of the children in order to sign off on the remainder interest of the deed. And then even if they do sell it and you get their permission, a larger chunk of the proceeds are going to end up in the hands of the child rather than you. That creates adverse income tax consequences to the child. Plus, you who sold the house might need the money to buy another house or a downsized house or move, all of which create problems. Never mind creditor problems for the children while they're living. Folks, don't do the life estate this way because it seems to create more trouble than it's worth.
Learn how you can avoid probate, eliminate estate taxes, keep your money in your family, and protect your assets from the nursing home. Request this brand new guide from Cushing & Dolan. It's called Calculating the Consequences of a Life Estate. Call 866-848-5699. That's 866-848-5699. Or you can simply request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Marc Fandetti.
Good morning. Welcome back to the Financial Exchange. If you liked the rebound we saw towards midday trading yesterday in stocks, you're not going to be terribly happy about what we're seeing this morning. The Dow Jones Industrial Average off about 1,100 points, 2.25%. S&P down 142%, and the Nasdaq down 477, 2.1%. As we mentioned yesterday, you shouldn't read too much into a single-day move on stocks to interpret what investors might be doing next. But it's day two in trading, at least, of this conflict in Iran, becoming a little bit clearer that it is not just going to wrap up in a couple of days, as the president himself has mentioned. And we're starting to see things move around in markets, and this time beyond just oil markets, though those are moving as well. We enter today with oil prices up an additional 8% after, I think, closing up a good 5 to 6% yesterday. In total, that brings West Texas crude from about, $65 a barrel at the close on Friday, up to where we are now at $77 per barrel. We're obviously already seeing that filter into gas prices across the country. AAA puts the average today at $3.11 per gallon, up from a little under $3 a gallon as of late. And then the other piece that people are talking about, which we will get to why this is happening, but interest rates on the move, mortgage rates, the piece that people can most commonly relate to. As of yesterday, according to Mortgage News Daily, the average 30-year fixed rate mortgage had jumped from just under 6% to 6.12% yesterday, and climbing further today. So I think, taken in the aggregate, whatever it was that drove equity market investors to be calm yesterday is clearly not carrying through to today. And obviously, as time goes on, we're learning a little bit more. And so I want to talk about some of the big economic disruptions that we concretely know about today across the Middle East. And then I don't really want to hypothesize about how long this is going to go on, how much it will pull in other countries throughout the Middle East. That's pure conjecture, I think really starting with what we know today. One, the Strait of Hormuz effectively closed, mainly not so much because the Iranians have effectively closed it, but the threats were enough to cause insurance companies to effectively cancel coverage for anybody that wants to navigate through the strait, and premiums, in order to do so, increased by as much as 50%, making that type of insurance just non-viable for any sort of operators. And as has been cited elsewhere, roughly 20% of global oil and LNG traverses through this choke point. So pretty clear what's happening in the oil markets. I think most people are aware of that. For those that don't travel regularly, either to the Middle East or through Asia, I think some might be surprised at just the volume of transit through those areas. You were talking before, Mark, about several of these areas being financial hubs and people that work in financial services being kind of stranded there for the moment. Israel, Qatar, Syria, Iraq, Kuwait, and the UAE partially closed their airspace. Temporary shutdowns of some big global hubs, including Dubai, which a lot of flights fly through, Doha, Abu Dhabi. Over 1,800 flights were canceled within the first 48 hours of the conflict, and that's leading to severe travel disruptions. Not only, but I think importantly, not only across the Middle East, where a bunch of big airlines operate, but transiting the United States to Australia or to China, oftentimes connects through there, or connecting Europe to those places connects right through the Middle East, and has been seen, at least over the last 20 years, as a safer place to transit through.
50 years ago, Dubai International Airport had about 2 million passengers a year. Today, the figure is nearly 100 million.
Okay. Pretty significant growth hub. Obviously, there have been attacks on energy infrastructure. In addition to just the transiting through the Strait of Hormuz, there was a Saudi refinery strike. There was a Qatari LNG halt after that place was halted. And so LNG prices, you saw in Europe at least, spike by 50% in a single day on the result of that. That's not something that we feel domestically quite as much, but, obviously something that is to be aware of. And then, when you talk about all this, you have stock prices here in the United States, but markets in places like the UAE and Kuwait, in some cases, were completely suspended trading because of the volatility taking place in some of those markets. And so, there's some big questions across the Middle East as to how all of this develops. And I don't think it is terribly surprising to be sitting here in a moment where it feels like equity market investors in the United States aren't really sure what to do.
One of the big differences between today and I'll say 50 years ago, I'm rounding up a little bit, the last regime change in Iran. And we can get into oil intensity of the U.S. economy and other things like that as the program unfolds. But stocks are much, much more expensive today relative to earnings. We talk about PE metrics a lot as one way to answer the question, how richly or not priced are equities. The 10-year inflation-adjusted the 10-year average inflation-adjusted earnings, which we sometimes call the cyclically adjusted PE ratio, or CAPE.
Sure.
It was 1/4 of its level in 1978, the last revolution, 78, 79. 1/4 of its level today. So said differently, stocks are much more expensive relative to future earnings. That's one question that ratio answers today than they were in 1979, which makes them a lot more vulnerable to big, sharp pullbacks.
It does. And I think, look, the lesson from the last probably quarter century or so has been, when it comes to big geopolitical tensions, kind of fade it to background noise because it's not likely to have a big disruptive impact on the U.S. economy. And I think that's largely the strategy that investors are trying to take here. I don't know that it will play out that way, but that has been, I think, a pretty common lesson from the last quarter century is, in spite of big geopolitical concerns and issues in Russia and Ukraine, war in the Middle East, U.S. involvement in those things, hard to pinpoint an area where it's been truly disruptive to the structure of the U.S. economy or structure of U.S. markets. Those have been dominated by other forces. And so part of the lesson that I think investors have taken is, okay, pay attention to this stuff, but kind of fade it to the background when it comes to making your long-term investment decisions. And we will see if that is the same lesson that holds true this time around.
Yeah, in 1990-91, the operation was UN approved and limited in scope. Oil prices rising hit at the same time as the economy was slowing. The Fed was trying to slow inflation at the time. And so we did have a brief recession. It was pretty shallow. I don't even think there were there may have been two consecutive quarters of a contraction in GDP, but again, it was shallow. The recovery was painfully slow, and of course, it cost George H.W. Bush the presidency. So that's probably the most similar to today, where the economy is less energy intensive today, and we could talk about what that means as the program unfolds. But in the modern era, that's probably the closest parallel. The economy slowed a lot from the third to the fourth quarter. We saw that last week. So similar to that episode, and I'm straining here a little bit, but similar to that episode, we got a slowing economy. The Fed did start to ease dramatically in 90-91. Well, not dramatically enough. The Fed was easing, as it is today. The economy was slowing, as it is today. That's one parallel, Mike. The big difference is that was done under the ambit. That was done under the umbrella of a UN-approved action with 100 and some odd other countries backing us. Very limited scope.
Mark, off air this morning, you and I and others were talking about recessions. Let's call it before 1990, and the perception that a lot of them caused by things like oil price spikes, and how this moment in time
that was the story
in the
post-war.
Right, in previous decades would be seen as a real recession risk. I want to take a quick break, but then I want to talk through that thought process and how energy price spikes can lead to economic pullbacks, and what is different structurally about the importance of oil in the world and U.S. economy today compared to decades past. That's next here on the Financial Exchange.
Stay informed and prepared for market changes and breaking business news. The Financial Exchange is live every day on YouTube. Tune in, subscribe, and keep up to date on all of our show's content on a daily basis. This is the Financial Exchange Radio Network. If you're ready for a getaway that feels easy, relaxed, and completely refreshing, it's time to discover the U.S. Virgin Islands. This is your invitation to fall naturally in rhythm with the heartbeat of the islands, where the water is warm, the breezes are gentle, and every day moves at just the right pace. Getting there is simple. There's no money to exchange and no passport required. Just pack your bags and go. Right now, experience St. Croix's special promotion, a vibe like no other. You may be eligible for a $250 per person airfare credit when you book through participating hotels using promo code VIBE2026. Imagine spending your days exploring historic towns, relaxing on beautiful beaches, and soaking in the unique culture that makes St. Croix truly one of a kind. Book between now and June 30th for travel through August 30th and start planning your escape to America's Caribbean today. Explore St. Croix's vibe like no other as part of America's Caribbean paradise. Learn more at visitusvi.com and plan your trip using code VIBE2026. That's visitusvi.com.
As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be funded, it's important to have a clear plan for how all of your upcoming costs will be handled over time. Divorce also means adjusting to a new financial reality, where one household becomes two and your budget, saving strategy, and long-term goals may need to be reevaluated. Our new guide is called Divorce and Your Financial Plan, and it discusses ways to build a financial strategy that supports your family's next chapter. You can get your free guide today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Many families consider using a life estate as part of their planning, but without a clear understanding, it can lead to unintended consequences. Cushing & Dolan have a new guide called Calculating the Consequences of Life Estates that explains what to watch for and how to think through your options before making any decisions. Key rules to be aware of include the 5-year Medicaid lookback, where the state reviews financial transactions over the prior 5 years, and certain transfers, like giving away property or assets, can create a period where benefits are delayed. Call Cushing & Dolan at 866-848-5699 to request your free guide today. That's 866-848-5699. Or request the guide online by visiting our website, legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Miss any of the show? The Financial Exchange Show podcast is available on Apple, Spotify, and iHeartRadio. Hit the subscribe button and leave us a 5-star review. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you by the U.S. Virgin Islands Department of Tourism. Experience America's Caribbean and fall naturally in rhythm with the heartbeat of the islands while enjoying incredible beaches, world-class cuisine, and unforgettable sunsets. Act now and take advantage of a special promotion to St. Croix called A Vibe Like No Other. You may be eligible for a $250 per person airfare credit when you book through participating hotels using code VIBE2026. For more information and to book your trip, go to visitusvi.com and use code VIBE2026. That's visitusvi.com and use the code VIBE2026.
Mark, over the last 2 days, oil prices have surged by, let's call it 15-ish%. You pointed out during the last segment that in previous generations, really post-World War II, you would have seen an oil price spike like this accompanied by a lot of people theorizing about recession in the United States.
Because it always happened.
And I hear a lot of concerns about, a lot of things right now when it comes to this conflict, but very few of them are focused on how this specifically is going to cause a recession in the U.S. So what's changed on that narrative other than the obvious, which is the United States is now a very large oil producer? But what was the going theory, I guess, prior to the modern last quarter century or so when it comes to oil prices and recessions?
The reason I say that is that we've had 12 recessions in the post-war era, including COVID.
Okay.
Every one but two was followed by a big jump in the price of oil, including 2001. We don't think of that as being oil-induced, but oil roughly doubled in the run-up. I just checked to make sure I was remembering that correctly. So it is, a researcher would call that a very strong empirical relationship.
And what's the theory there? Like, hey, I've got fewer dollars to spend on everything else?
Yeah, the short-run sensitivity.
It's like a tax increase?
You can't control how much you drive in the short term for the most part. You can cut out some trips. You can double up on some trips, stuff like that. But for the most part, the elasticity, as a researcher would say, which means exactly what it sounds like. How much does my spending on something change when the price of it goes up? If it doesn't change at all, you'd say my spending is inelastic, a reason would say. Sometimes you see that term thrown around, and you may see it in the next few weeks as people talk about the elasticity of spending on oil. So that's why I digress a little bit on that concept. So you get this phenomenon that oil price spikes have almost always been followed by recession. There have been a couple of counterexamples. 2003, again, I looked this up to make sure I was getting this right. There was a spike, didn't cause recession. The run-up to the global financial crisis of 2008 through 9, roughly, was preceded by a slow but unyielding, pretty steady rise in the price of oil. Though many, and you may recall that oil hit like $1.50 a barrel, something in that range. So there were other contributing factors to the GFC, but oil certainly didn't help. So there's this strong relationship, Mike, that cries out for an explanation. Does that mean it's going to happen again? Of course not. One of the things, as you guys know, and as listeners probably know, is that the extent to which not just the extent to which we rely on foreign oil, because that's really not relevant. Oil's a global commodity.
Sure.
It has a global price.
Price goes up, and we will all feel it regardless of how much we produce here.
Thank you. Perfect. There's this question of, well, we need much less oil to produce $1 worth of GDP than we did 50 years ago. We need about 70% less oil to produce $1 worth of GDP than we did in the early 1970s. That may argue for a diminished economic impact.
I would also imagine there's some formula here by which, with increased oil prices and the fact that the U.S. does now produce 20% of the world's oil supply, that, with increased prices, employment in the sector can increase over time, and other factors lead to higher profits for domestic companies.
The question is, do they spend that to the same degree? Can that offset the retrenchment on the part of everybody else because we're paying more for gas?
I would think not. It's not a hugely labor-intensive industry.
I'm scanning. I'm reacquainting myself, or first time acquainting myself with the research in this area, and it seems to be that our spending on gas is way less. No, it doesn't make up for it, is the short answer, like you just said.
The Wall Street Journal has a piece today. Greg Ip wrote, and I'm going to quote for a minute here, taking the optimistic outlook on this, which is always difficult to do in the midst of the fog of war. But, quote, if Iran, along with Venezuela, is soon ruled by a regime friendly or at least not hostile toward the U.S., that would neutralize two oil exporters who have regularly been the cause of supply disruptions in recent generations, basically leaving Russia as the only adversarial oil power. And while I do take Greg's point on this, that yes, if Iran is no longer causing issues in the Strait of Hormuz, if Venezuela is not doing the things they do, I'm just really unsure how valuable that is in 2026. To your point, the U.S. is less dependent on that oil. The economy as a whole is far less dependent on that. And I've just been thinking this through in the context of other, not necessarily commodities, but other areas of the economy that would be horribly disrupted by this type of conflict. And obviously, my mind immediately goes to Taiwan and semiconductors. And I just think through, one, this has a lot to do with concentration, where I think at last look, OPEC was producing 35 to 40% of the world's oil, whereas Taiwan produces 99% of the world's semiconductors. But I'm just unconvinced that in 2026, oil production and stability among Venezuela and Iran is the far most important structural thing to the U.S. economy, which is the piece that Greg is in a roundabout way making is, hey, maybe if this all goes well, the world will be far more stable in terms of oil prices, and how beneficial would that be towards our economy? And at the same time, I'm thinking, well, yeah, but there are now other things that seem far more important to me than oil prices and oil stability.
So his point is that oil could be a little cheaper if we pull all this off?
I think the point is more that there will be fewer of the shocks if we pull this off. So not so much that oil might be cheaper. I don't think anybody has any idea. But if there are fewer volatile regimes that strongly disagree with their neighbors and generally speaking,
the shocks
the
will come
United States,
from that. I mean, you can't. Shocks are whack-a-mole.
Yeah.
You can't. It's that all else equal logic that casual commentator, forgive me, it sounds a little snooty, but casual commentators, like, okay, great, you had this little mental experiment and you found it interesting, so you wrote about it. You can't hold all else equal. There could be shocks elsewhere, and to your point, we're less energy dependent. How much is it really going to matter? Foreign energy independence, as we said, really doesn't matter, though. I don't know, Mike. That doesn't really. It doesn't really do it for me.
It didn't fly to me. I'm just thinking about
whatever.
the context.
He's got to write something.
I think about the context of this and oil prices versus the context of something as important as the United States developing its own domestic semiconductor industry. And I know I'm connecting things that are seemingly very disconnected, but a lot has been talked about recently about the stability in Taiwan, threats from China, and other areas of focus. And to me, a lot of this, while critical for the Middle East, seems like a bit of a distraction from the most crucial things. We got to take a quick break. Wall Street Watch is coming up next. Stocks selling off very strongly in early trading here. We'll have a full recap next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Lori Trahan are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up.
Because we have something better.
Stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit goredforwomen.org today to learn more.
Protecting your home with the life estate can be problematic if you don't understand the rules. Cushing & Dolan's new guide called Calculating the Consequences of Life Estates can help you learn about how this strategy works and what to consider. Call Cushing & Dolan at 866-848-5699 and get your guide today. Or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
If you're ready for a getaway that feels easy, relaxed, and completely refreshing, it's time to discover the U.S. Virgin Islands. This is your invitation to fall naturally in rhythm with the heartbeat of the islands, where the water is warm, the breezes are gentle, and every day moves at just the right pace. Getting there is simple. There's no money to exchange and no passport required. Just pack your bags and go. Right now, experience St. Croix's special promotion, a vibe like no other. You may be eligible for a $250 per person airfare credit when you book through participating hotels using promo code VIBE2026. Imagine spending your days exploring historic towns, relaxing on beautiful beaches, and soaking in the unique culture that makes St. Croix truly one of a kind. Book between now and June 30th for travel through August 30th and start planning your escape to America's Caribbean today. Explore St. Croix's vibe like no other as part of America's Caribbean paradise. Learn more at visitusvi.com and plan your trip using code VIBE2026. That's visitusvi.com.
This is Mike Armstrong and Paul Lane from the Armstrong Advisory Group out with our brand new guide for the month of March about divorce and your financial plan. And certainly while it's not the path that anybody hopes to go down with their marriage, many marriages do result in this, and it results in a full reformatting of their financial scenario. Now, Paul, understanding these different assets that ultimately need to get divided in the event of a divorce gets pretty complicated. So let's start with the basics when you're thinking about retirement assets versus the home versus, say, a checking account. How does one need to be thinking about these different buckets of money when they're talking about the equitable division of assets in a divorce?
Yeah, Mike, first you have to divide out those different assets into those buckets you were alluding to before: pre-tax retirement savings, real estate, as well as after-tax investment accounts. And what you have to understand is with the pre-tax retirement savings accounts, there are taxes and potentially penalties associated with those. So those assets are not equal to perhaps some money in a bank account, for example, that is much easier to access and withdraw. Same thing with real estate. Equity might be significant in a property, but there are a lot of carrying costs and expenses associated with that ownership.
Yeah, these things are complicated, and unfortunately, what it can lead to if you're not prepared for it is a division of assets that doesn't work out in your favor once you consider the after-tax implications of that division. If you have questions that you're facing as you head towards this life move, get your copy of our new guide, Divorce and Your Financial Plan. It's available by calling us at 800-393-4001. Again, it's the free guide, Divorce and Your Financial Plan, 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are selling off significantly following yesterday's midday comeback as investors are growing more concerned that the conflict with the U.S. and Iran could last longer than expected. Oil prices leaping higher again today as a result. Right now, the Dow is down by about 2.5%. S&P 500 down 2.3% or 156 points. NASDAQ selling off 2.5% or 569 points lower. Russell 2000 down 3.5%. 10-year Treasury yield up 1 basis point at 4.071%. Crude oil jumping 8% higher, trading at $77.44 a barrel. Target beat earnings expectations, but posted lower profit for the holiday quarter, marking its 13th straight quarter of declining sales. New CEO Michael Fandetti teased the retailer's turnaround plan will be presented shortly. Target up by 3%. Sticking with retail, where Best Buy's quarterly sales and outlook disappointed, but its adjusted per-share earnings came in strong, sending shares in the electronics retailer up by 5%. Meanwhile, shares in the social media platform Pinterest jumping 5% after Elliott Investment Management made a $1 billion investment, where the company plans to use the money to buy back stock as part of a $3.5 billion share repurchase program. Elsewhere, database company MongoDB offered a soft quarterly guidance, fueling concerns that AI could upend its business. Shares are tanking 25%, and Swiss sneaker maker On Holding is seeing its stock tumble 13% after the company's annual sales guidance underwhelmed investors. I'm Tucker Silva, and that is Wall Street Watch.
Mark, before the break, we were talking a bit about the overall conflict and potential impacts. And look, I've been asked, 3 or 4 times over the last few days, well, what sectors are going to be most heavily harmed or benefited by something like this? And the answer is nobody. Nobody knows. It is very early to try and understand what's going to happen here and how deep the conflict is going to be and how and why it could disrupt the U.S. economy. But like another conflict just 4 years ago, I think there are a couple things that you can say are more likely than not. And one of them that I'm comfortable saying is it's very difficult for me to envision a scenario where a conflict in the Middle East that drives up oil prices in the short term would be disinflationary. Difficult for me to envision that scenario, right?
I've not heard any serious person make that argument.
I can't imagine how it
so
could
maybe
be.
rule that out.
Right, so if anything else, I think we can rule out.
Hold on. I mean, just, for the sake of filling some airtime maybe, why might it be disinflationary? Well, the economy tumbles into recession,
disarray. Everyone gets afraid of going outside. Then
markets fall. There's a wealth effect associated. I'm just playing it.
Yeah.
out. I'm just playing it out.
Sure.
It's like you asked an exam question. You're looking for a creative answer or something.
But in any case, we have oil prices moving up. We've got bond prices moving down, meaning yields moving up, and I think you also have new spending on defense, which has been pretty consistent over the last couple of years as the United States kind of rebuilds some of the stuff that's gone to Ukraine over the last few years, but presumably the cost of conducting a series of strikes and war in Iran is going to cost the defense budget some. And so all of these lead, I think, me to come to the conclusion that it's more likely than not that this is a high pressure on upper prices, or at least unlikely to result in disinflation in the U.S. economy. And perhaps that is some of what is contributing to the sell-off that we are seeing because, as we mentioned, bond prices are reacting. Today, not a huge surge in bond yields. We've got the 10-year Treasury up barely 0.02% up to 4.07. It got up to 4.09. And that practically means that mortgage rates are moving up, and practically speaking means that it's looking tougher, I think, for the Fed to conduct a rate-cutting cycle in this environment.
Yeah, the Fed can't cut rates when the price of when the price of energy, which is a big part of headline CPI, is going up. That will push up the price of goods into which energy is an input. It will push up inflation expectations. The Fed made the mistake in the 70s of not reacting to energy price spikes when underlying inflation was elevated.
Even shorter term, more recently, I think that one of the main criticisms of Jay Powell in 2022 and the Federal Reserve then was taking a look at the Russian invasion of Ukraine and saying, well, it's hard to say what impact this could have on prices, when pretty clearly it ended up having upward pressure.
The Fed can either accommodate, is the language that monetary researchers use, or not, a so-called supply shock. So there's a lot of jargon in that one little sentence. Accommodate means either ease or don't react when the price of something, in this case it's oil, it could be any number of things that are meaningful or not meaningful. Like anything that goes into CPI could, in theory, push inflation up. If its price changes, goes up, and other prices stay the same. That is when CPI is calculated, that will push up the average price. So the Fed then has a choice. Do we respond to this because inflation has gone up, or do we, like the COVID Fed chose, do we believe that it will pass, that it'll be so-called transitory, and therefore we don't need to respond? Well, the danger in not responding is that inflation expectations rise with inflation, and then the process sort of becomes self-perpetuating and self-fulfilling. So everybody pretty much agrees that the Fed should have reacted sooner. The cost would have been some output, more specifically, higher unemployment. But the benefit would have been lower inflation. The Fed is going to be faced with a similar choice here.
We hear the, conclusion or phrase, oil seeps into everything, right? And what I'm talking about here is that, whether you are Target or American Airlines or your neighborhood grocery store, if energy prices increase, generally speaking, it's going to lead to higher input costs to you as a business, and it could lead you to need to raise prices in order to maintain margins. How much of an actual effect do we see there, right? Like, do energy prices actually lead to higher inflation, core inflation? Like, when you look at actual data points here throughout history, how can the average person conclude what might happen with prices overall if we see an oil price spike?
Look, if you're interested in this, we're not going to do it now, obviously, but if anyone wants to take this offline, the guy to read is Alan Blinder. He wrote a famous paper in the very late 70s. He updated it in the early 80s. He updated it again in 2008, 2009 with a co-author. And he documented that, a jump, in this case in oil prices, does make its way into core inflation. Whether or not that results in persistent and prolonged inflation depends on whether or not that it's just a one-time increase followed by a decrease, a one-time increase followed by a leveling off, a one-time increase followed by further increases. It depends on how long or short-lived this conflict is, Mike. But the short answer is, and you're going to hear a lot, I think, over the next couple of weeks, that just because the price of oil goes up doesn't mean inflation goes up. That's a really wrong thing to say. And I can understand why someone who hasn't thought about it much, maybe, or has some ulterior motive might want to, or maybe someone who wants to just be reassuring might say that, but it's wrong. It's wrong empirically, meaning that's not what's happened historically, and it's wrong in theory, too.
Let's take a quick break. When we come back, we're going to take a break from the overall story here when it comes to Iran, oil prices, and the price spikes here, because prior to all this, there was big dispersion going on in markets that we've started to allude to, but sectors that had been performing, not performing in 2026. And the variation in returns between individual companies across the S&P 500 in U.S. stocks, again, even before the attacks in Iran, were notable and like something we haven't seen in quite a few years. We're going to take a quick break, then we're talking about that market frenzy a bit next on the Financial Exchange.
When business news breaks, we're talking about it on X. Watch the Financial Exchange every day live on X. This is the Financial Exchange Radio Network. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Protecting your home at the Life Estate can be problematic if you don't understand the rules. Cushing & Dolan's new guide called Calculating the Consequences of Life Estates can help you learn about how this strategy works and what to consider. Call Cushing & Dolan at 866-848-5699 and get your guide today. Or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be funded, it's important to have a clear plan for how all of your upcoming costs will be handled over time. Divorce also means adjusting to a new financial reality, where one household becomes two and your budget, saving strategy, and long-term goals may need to be reevaluated. Our new guide is called Divorce and Your Financial Plan, and it discusses ways to build a financial strategy that supports your family's next chapter. You can get your free guide today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
All right, Mark, time for technical term definition time. I'm hoping you can help me out. Market dispersion. Bit of a technical word. What are we talking about when we talk about market dispersion and how it's particularly, I guess, wide or severe this year?
How spread out the winners are from the losers. So pretend you had a market of two stocks, A and B. One is up 50, one is down 50. If it's a market cap weighted index and the companies are the same size, your market return is zero, but that hides a lot of volatility under the surface.
So here's how the Wall Street Journal, quantified some of this stuff. So the S&P 500 this year has traded within a range of just 2.7%. The average company in the index, so again, the S&P 500 is taking an average, but it's taking a market cap weighted average, where this is just saying, okay, what's the average return of the individual components of here? It's been moving around about 7 times the degree of the index in total.
Okay.
So average company moving up or down 14% throughout the course of this year. Index itself up 2.7%. They point out that this is pretty severe in terms of how much the dispersion exists. It's the ratio. It's the largest it's been since 1994.
How do they calculate the average? Is it a simple average or is it a weighted average?
I would imagine it's a simple average.
Okay.
They're getting the data from Barclays, but the way that they are phrasing this to me means simple average. They're not saying it matters more that Microsoft is down 18%.
So they're not market cap weighting it.
I think they're just taking averages and saying how wild their stock is up and down.
Good. Sorry, I'll let you finish.
No, please.
Is that unusual?
Well, it's the most dispersion since 94, but that doesn't mean that it wasn't very close in 2022 or something like that. So I think the main question that I had with this is, who does this actually matter for?
Why did you write this piece?
Right, should I care?
Why am I reading this?
Should I care? Because a few things.
Yeah, totally.
One, I don't think anyone, or I didn't see in the Wall Street Journal article, anyone doing any sort of analysis to say, and when this happens,
right, there you go.
Historically, you've seen a vast market downturn. We certainly didn't get one. I guess we saw some market turmoil in the mid-'90s, but largely it led to...
The Fed started raising, right? Well, go ahead. I'm not going to take you down memory lane with me.
Largely, markets continued moving right up through the dot-com bubble, so I don't think that's an issue. But I guess who it does matter for is if you are not that plain vanilla buy S&P 500 and sit there for the next 2 decades, then it matters a heck of a lot for you. And so if you are this individual stock investor who has made their entire portfolio out of the Mag 7, well, one, that might not have been the most stable idea in the first place, and you should expect volatility. But maybe you are an individual stock investor, or maybe you are somebody who does move their holdings from sector to sector. Then this year feels a lot different to you than in the last few years. I guess where I keep going back to, though, and I'm not sure this is a good thing or a bad thing, but when you take a look at how much money has flowed into mega diversified index funds over the course of the last 2 decades, the portion of investors that this actually disrupts is pretty small. It is fascinating to me. It's interesting to me that we can have a market where Nvidia and Microsoft are down in 2026 and the index until today was up for the year. That's fascinating and interesting, and it signifies something to me. But for the average person, doesn't feel like
I think
a whole lot.
It's a marketing talking point for active managers. They want you to think that the environment is a fertile one for them. Ooh, look at all this dispersion. I'm going to jump in and take advantage of it. It doesn't follow from the fact that there is more dispersion, that stocks are moving around a lot more on average than the market cap weighted average. It doesn't follow from that you'll make money with
that. Would be the
manager. They have to have the skill to exploit it.
That would be the fascinating and interesting question to me, which it's too late to take advantage of now anyway, but is there any evidence that active mutual fund managers, for example, outperform their benchmark in years where there's more dispersion?
Yes, there is, but they're not the same ones who did it the last time dispersion was high. So they're just the lucky coin flippers this time around. So the answer to your question is yes.
Yeah, okay.
And they want you to, and they'll show you a graphic with, and when I say they, and if I sound a little cynical here, it's because I am of active managers generally. Not that some aren't good, but most are no good at all, and they know it, and they're just trying to fool you so that you'll hand your assets over to them, and they can charge you 10, 20, 30 times what you'd pay for an index fund. There's my little homily on active management. Most people should avoid it. That said, there are very few who can exploit environments like the one that we're in today. The problem is that those winners generally lose their touch over time if they can repeat it all.
If you're ready for a getaway that feels easy, relaxed, and completely refreshing, it's time to discover the U.S. Virgin Islands. This is your invitation to fall naturally in rhythm with the heartbeat of the islands, where the water is warm, the breezes are gentle, and every day moves at just the right pace. Getting there is simple. There's no money to exchange and no passport required. Just pack your bags and go. Right now, experience St. Croix's special promotion, A Vibe Like No Other. You may be eligible for a $250 per person airfare credit when you book through participating hotels using promo code VIBE2026. Imagine spending your days exploring historic towns, relaxing on beautiful beaches, and soaking in the unique culture that makes St. Croix truly one of a kind. Book between now and June 13th for travel through August 13th and start planning your escape to America's Caribbean today. Explore St. Croix's vibe like no other as part of America's Caribbean paradise. Learn more at visitusvi.com and plan your trip using code VIBE2026. That's visit usvi.com and code VIBE2026.
Mark, I hate making assumptions about people, so I'm going to try and avoid it here. But my assumption about you is that you don't frequently visit Target. Is that a reasonable conclusion?
You kidding?
No, you're there all the time?
Oh, yeah.
Okay. So what is your conclusion about Target as just a place to shop compared to their competition?
Well,
Why do you go
I
there?
haven't sampled because it's close and they bring stuff out to your car.
Got it. Okay.
And they're tolerant when my dog lunges at them. Well, the window's closed,
nice.
but
that's a nice few
you
qualities
get
from them.
5% off if you link their debit card to your bank account.
I didn't even know that. That's a decent perk.
Yeah.
For those that are unaware, Target has had a pretty rough couple of years. The likes of Walmart have been investing heavily in areas like grocery and online delivery. Target kind of struggled to keep up, and frankly, a few missteps here and there, but I think largely their problem has been inability to really differentiate their brand and stay modern. The new CEO has been pushing pretty heavily and investing pretty heavily, and released earnings this week. And on a day when the stock market overall is selling off by 2.33%, Target stock is up 3.33%, which says something. It's basically flat for the last 12 months, so not a great story for investors overall. But they have been investing pretty heavily in improving merchandise, refreshing their stores, integrating new technology into their operations. And I can't say I'm intimately familiar with Target's business overall, but I can see how those things are necessary at this stage. The piece that I don't know what they should do with is their grocery business, because they're in this position where their groceries, in my opinion at least, kind of suck. Like Walmart
Prices are
has
good,
a
though.
full
They don't have the
full-on
selection.
grocery
They
store.
don't have the selection that.
I can't go to Target and do a grocery shop. If I'm there, I might buy some milk, but that kind of makes it like a CVS. If I'm there anyway, maybe I'll get these cough drops, but I'm not going to go there intentionally. Quick break. A lot more to cover in the second hour of the Financial Exchange. We will be right back.
If you're ready for a getaway that feels easy, relaxed, and completely refreshing, it's time to discover the U.S. Virgin Islands. This is your invitation to fall naturally in rhythm with the heartbeat of the islands, where the water is warm, the breezes are gentle, and every day moves at just the right pace. Getting there is simple. There's no money to exchange and no passport required. Just pack your bags and go. Right now, experience St. Croix's special promotion, A Vibe Like No Other. You may be eligible for a $250 per person airfare credit when you book through participating hotels using promo promo code VIBE2026. Imagine spending your days exploring historic towns, relaxing on beautiful beaches, and soaking in the unique culture that makes St. Croix truly one of a kind. Book between now and June 30th for travel through August 30th and start planning your escape to America's Caribbean today. Explore St. Croix's vibe like no other as part of America's Caribbean paradise. Learn more at visitusvi.com and plan your trip using code VIBE2026. That's visitusvi.com. Life estates are sometimes used to protect your home as part of your future, but it's important to understand how they really work before making any changes to your estate plan. Cushing & Dolan are experts in elder law and taxation. Their new guide, called Calculating the Consequences of Life Estates, explains the pros and cons and why careful planning is so critical. A life estate can allow you to remain in your home while transferring future ownership. But decisions like putting the property in your children's names versus using a trust can have very different consequences when it comes to taxes, control, and protection from creditors. Before you sign any deed or transfer property, be sure you understand your options. Call Cushing & Dolan at 866-848-5699 and ask for your free guide today. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Our Senators Edward Markey and Elizabeth Warren and Representative William Keating are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is the Money Matters Radio Network. WBNW 1120 AM and W275CM FM. Concord, Boston. The Money Matters Radio Network.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Divorce isn't just a legal process. It's a financial reset. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and our new guide, Divorce and Your Financial Plan, walks you through how to take inventory of your assets, avoid common mistakes when splitting accounts, update beneficiaries, and start building a plan that works for your next chapter. Divorce is complicated enough without all of its financial ramifications. The decisions you make now can have lasting consequences for your future, because after a divorce, it's not just about who gets what. It's about making sure your financial life is truly separated and set up to support your goals going forward. Call the Armstrong Advisory Group right now at 800-393-4001 and get your free guide, Divorce and Your Financial Plan. That's 800-393-4001 or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
Hi guys.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESI is there as your partner. the Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange Quick Tip of the Day. And today, we're talking about the use of life estates and your primary residence. Todd, does the 5-year waiting period for Medicaid eligibility apply to the creation of a life estate?
Well, the short answer is yes, it does. But let me explain why it does. So, first of all, when you create a life estate, again, the general way people do it is they tend to put the remainder interest of the property in the hands of children. I don't like it that way, but that's how they do it, when you could have the remainder interest with the trust. But the moment you put the child's name on the deed and you reserve the right to live there is a completed gift for gift tax purposes. No one thinks of that, but now you technically need to file a gift tax return. And it's that creation of the gift, it's that transfer of that remainder interest in the property to the child for less than fair market value that triggers the disqualification period for Medicaid. So that's why you have to wait 5 years after you create this life estate arrangement in order for the house to be protected from the nursing home. It's very hard to avoid the 5-year waiting period, folks. There's really not too many ways around it.
Learn how you can avoid probate, eliminate estate taxes, keep your money in your family, and protect your assets from the nursing home. Request this brand new guide from Cushing & Dolan. It's called Calculating the Consequences of a Life Estate. You can get it by calling 866-848-5699. That's 866-848-5699, or you can simply request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Marc Fandetti.
Welcome back to the Financial Exchange. It's Mike, Marc, and Tucker with you on a Tuesday as investors continue to digest the events out of the Middle East and Iran specifically, obviously. We have markets selling off pretty strongly, although recovering a bit of their losses at the 11 o'clock hour now compared to yesterday, where the markets were all over the place during pre-market trading, but relatively calm during the Monday session. after the Saturday morning attacks on Iran from the U.S. and Israel. We've got the Dow Jones Industrial Average now down 990 points, about 2%. The S&P down 125 points, 1.82%. The NASDAQ now off 435 points, 1.9%. The yield on the 10-year Treasury moving up a little bit as investors sell off their U.S. government bonds a tad, up to 4.077%. That is seeping its way into mortgage rates, where yesterday the 30-year fixed-rate mortgage topped 6.1% after spending last week down below or at 6.0%. So you have mortgage rates moving up a bit. Oil prices surging as well for the second day in a row. Brent crude now topping $83 per barrel. West Texas crude up 7.5% to $76.63. Nat gas prices have also been dramatically affected here. And then the other interesting one, U.S. dollar, been holding up fairly well throughout all of this. And while people not necessarily buying government bonds at the moment, certainly flocking to U.S. dollar during this period of time of volatility. So all of those naysayers that, the dollar dominance and dollar was going to be dead over the course of the years. Well, we're seeing again in times of turmoil that the dollar index over the last couple days at least did all right and held up fairly well. Anything else in markets catching your eye this morning?
No, I guess what's
Marc?
unusual, and you've already said it, is that U.S. Treasuries are not serving their typical safe haven asset role. Probably, and you've hinted at this, because inflation expectations will go up when the price of gas goes up, and all else equal, rising yields correspond to falling bond prices.
Yeah, and I hate to attribute any feeling or sentiment to markets overall, but I think one of them that I feel fairly comfortable saying is that there was an expectation built in that inflation would continue to moderate this year and the Fed would be capable of bringing down interest rates this year. And this directly challenges that assumption. Now, it wasn't held by everyone. I know you have in particular brought it up that, hey, I don't know that that's all that likely. But I think even you acknowledged that the Fed was going to have a bias
when we
for
got that
lower
bad
rates.
GDP, I'll call it bad, GDP slowed down. Economic growth slowed down a lot in the fourth quarter of last year. It was negative in the first quarter. It went like gangbusters for 2 quarters. Then it slowed down. Last year was a really volatile year economically and a slower growth year than the year before. We had no job creation.
Yep.
But I wasn't sure because GDP growth was so hot in the second and third quarter, way above what most researchers think is the economy's speed limit. I'm obviously just using shorthand there for the productive capacity or the growth of supply, if you prefer the more like technical concepts. But anyway, I was concerned that maybe the economy was growing way above trend despite the sluggish payroll numbers. Excuse me, and that maybe the Fed ought to be thinking about not just standing pat, but hiking to keep inflation under control, because inflation is what happens when demand outpaces, the growth in demand outpaces the growth in supply. Then we saw the fourth quarter GDP number, and I was relieved, I guess, in the sense that, well, maybe we're not pushing the economy too hot. Then something like this comes along, and that changes the calculation completely, Mike.
Yeah, it does. So ultimately, what really matters out of this conflict, other than what matters for markets and the economy out of this conflict, because there's a lot of things that matter for geopolitical stability, loss of life, and all the other important factors that are frankly far more important than what's going on with U.S. stocks. But for stocks, 3 real things matter about this conflict. The duration is important. The scope is important, right? Do other countries get tied into this? And the severity is important. And none of those do we really have any idea about right now. And so you will hear plenty of people out there putting out conjecture and guessing at what might happen next with stock prices or the AI trade or oil prices. And I think if anybody is not dealing with it with a heavy dose of skepticism, then they're lying to you, I think is my answer. I have no idea what sectors are going to perform well, perform poorly. I don't know if this will benefit energy companies in the long term and hurt airlines. I don't know that anybody has a real solid thesis on this because nobody knows how long it's going to last, how severe it's going to be, and how many other nations are going to be pulled into a crisis and potentially have different conflicts. And so,
yeah. If you had to speculate, you'd say, well, we know the president doesn't have much tolerance for market pain, and he's watching the stock market and interest rates, and he'll respond to that. And he
been
has
the case for the last 2 years.
Past. Yep. Yeah, he has in the past changed his position. He'll declare victory, so it's very good optics. He declares victory, says mission accomplished. Now we're moving on, even though effectively he's had to backtrack. He's able to frame it in such a way that he feels anyway that it doesn't look like. It looks like he's saving face. So if you had to bet, I think you'd say this is over sooner rather than later. We'll declare victory just like we did when we bombed them 3 months ago and said we eradicated their nuclear program. And we'll say we eradicated whatever the regime, now it's up to them. And the president will pull out or cease hostilities in response to continued market pain, if indeed the market continues to react the way it is reacting today. Although, as you pointed out, that's an open question. So if you had to guess, Mike, that would be my, for what it's worth, not that anybody should take my geopolitical speculations, should attach too much weight to them, but I think that's a reasonable guess.
In any case, I think it's fair to say that price shocks are bad for economies, generally speaking. We are getting a price shock right now with the price of oil moving as dramatically as it has over the last 2 days. It probably only matters if that price shock has staying power, and we'll see.
If
I don't
it
have an
reverses
answer.
in a week, it's hard to conclude that it would even affect inflation. If
Agreed.
it persists for more than a couple of weeks, well, it's going to make its way into headline CPI. Obviously, energy's about 10%. I'm rounding up a little bit of headline CPI.
And if it lasts a year or more,
well, then that's a different kettle of fish.
Then, Marc's got to cut back on his Disney Plus subscription and stop watching so many Star Wars shows so that he can afford to commute to work every day. I'm joking, obviously. I didn't know what to come up with on this, but if
you're not far off.
If you have to spend your money on gasoline because it's more expensive over the course of a long duration, then ultimately you can borrow the money, save less, or cut your spending elsewhere in order to make all those ends meet, and that's what people worry about when it comes to price shocks.
Yeah, well, this is where the term stagflation, came from. In the 70s, demand slowed as oil prices rose, and due to other factors, too. We were in and out of recession. In and out of recession is not the best way to characterize that decade, but demand slowed. Strangely, inflation did not slow, and that was stagflation was a puzzle. The word was invented out of that experience. That word came out of that experience because it was unusual. Everybody expected slowing economic growth to pull inflation down, and it didn't. During the big spikes, the 73 to 75, and then in the late 70s. So the question is, will we see that again? Underlying inflation is not as high as it was then, but it's a little bit elevated.
Let's take a quick break. When we come back, playing a little bit of trivia here next on the Financial Exchange.
The Financial Exchange is now available every day from 11 to noon on SiriusXM's Business Radio Channel 132. Stay informed about the latest from Wall Street, fiscal policy, and breaking business news every day. The Financial Exchange is live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be funded, it's important to have a clear plan for how all of your upcoming costs will be handled over time. Divorce also means adjusting to a new financial reality, where one household becomes two and your budget, saving strategy, and long-term goals may need to be reevaluated. Our new guide is called Divorce and Your Financial Plan, and it discusses ways to build a financial strategy that supports your family's next chapter. You can get your free guide today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Protecting your home at the Life Estate can be problematic if you don't understand the rules. Cushing & Dolan's new guide called Calculating the Consequences of Life Estates can help you learn about how this strategy works and what to consider. Call Cushing & Dolan at 866-848-5699 and get your guide today. Or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
If you're ready for a getaway that feels easy, relaxed, and completely refreshing, it's time to discover the U.S. Virgin Islands. This is your invitation to fall naturally in rhythm with the heartbeat of the islands, where the water is warm, the breezes are gentle, and every day moves at just the right pace. Getting there is simple. There's no money to exchange and no passport required. Just pack your bags and go. Right now, experience St. Croix's special promotion, a vibe like no other. You may be eligible for a $250 per person airfare credit when you book through participating hotels using promo code VIBE2026. Imagine spending your days exploring historic towns, relaxing on beautiful beaches, and soaking in the unique culture that makes St. Croix truly one of a kind. Book between now and June 30th for travel through August 30th and start planning your escape to America's Caribbean today. Explore St. Croix's vibe like no other as part of America's Caribbean paradise. Learn more at visitusvi.com and plan your trip using code VIBE2026. That's visitusvi.com.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Remember, you can watch the show live every day on our YouTube page. We've got market updates and breaking business news all morning long, plus a full archive of all our show's content. It's all there with the click of a button at youtube.com/The Financial Exchange Show.
All right, time for trivia here on the Financial Exchange. And on this day back in 1969, NASA launched Apollo 9 for a 10-day orbit around the Earth. 4 months later, NASA sent Apollo 11 out for a successful moon landing. So our trivia question today, how many Americans have walked on the moon? Once again, how many Americans have walked on the moon? Be the fifth person today to text us at 617-362-1385 with the correct answer, along with the keyword trivia, and you win a Financial Exchange Show t-shirt. Once again, the fifth correct response to text us to the number 617-362-1385 with the correct answer, along with the keyword trivia, will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Marc, Blackstone's flagship private credit fund was hit with a wave of redemptions, hit with $1.7 billion of net outflows in the first quarter as investors attempting to pull their funds from this mostly illiquid asset class. And I don't think anybody that doesn't operate in the space really understands what this means. So talk to us about what does Blackstone do and what does it mean when they're hit with $1.7 billion worth of outflows?
Well, the bonds that you own through, say, your 401k plan in Bloomberg Aggregate Index, they might even have that name attached to them. It's more likely just called the XYZ Bond Fund, particularly if you work for a big employer. Those are all publicly traded bonds. There are dealers who keep inventories of those bonds. So if the manager of the fund, in response to you wanting to sell, needed to raise capital, it's very easy to do so. It's easy to sell a U.S. Treasury bond, easy to sell Apple bonds or something like that. Private credit and equity, for that matter, as the name suggests, these are not publicly traded. I'm going to call them deals because they're not securities.
Right.
They're shares in companies, yes, but they're not publicly disclosed, regulated. Regulated is the better word. Disclosure doesn't have much to do with it. That's just sort of a side thing. So when you want to sell a privately owned security, and by the way, you probably don't own these directly or even indirectly. If you have a pension plan, part of your benefits are funded with private market investments. But for the most part, we don't have private investments available to us as individuals, or at least didn't until several years ago. One of the benefits of the higher returns promised by these, one of the benefits is the higher returns promised by these investments. One of the drawbacks is they're illiquid, fancy way of saying you can't get your money on a moment's notice like you can in a typical mutual fund or by selling a stock or ETF. And as soon as they tell you, we're going to put additional restrictions as per the agreement on this fund on withdrawals to protect shareholders. What happens when you tell people they can't run for the exits? They run for the exits.
Yeah, that is the natural result of all this. I think it's fair, at least in my mind, to assume that there's not a whole bunch of interest right now on the part of new money to say, hey, what can you do for me by jumping into private credit? I am certain there are investors who are curious and saying, hey, maybe it's a buying opportunity. Maybe I can, if I fund the right company, scoop up some potential good deals here. But that's not the overall
most don't have a choice, Mike. They
narrative.
made commitments to these funds years ago, and their capital gets called, and you can't get out of that obligation. For individuals, though, they can hold off on.
In any case, obviously, the funds themselves have been pushing hard to try and get into places like 401k plans and other new areas of potential investment, which I have expressed concerns about it and still feel that way. But I'm wondering who else it affects if the new demand for lending out this type of money is seeing some form of dry up. And again, that's maybe not a foregone conclusion, but it seems pretty obvious to me that pension funds aren't looking to allocate new dollars to this at this point in time.
Some might be. Smaller funds that were late to the game might be able to commit capital to it. Others who made commitments previously will have their capital called. That's how those things work. You don't know where your money's going ahead of time.
Right.
You make a commitment to a manager that you believe has skill and trust and all those great things. And then over time, they tell you, well, we need $5 million for this deal, and et cetera. So you don't have much control over the timing.
Like many other areas of the market, this is one of those that expanded fairly dramatically during COVID and throughout the 2010s. And my conclusion is just generally when money is pretty free and loose, as it was during COVID and has been throughout the existence of a lot of this private credit surge, is that sometimes bad loans are made. Sometimes loans are made to companies that can't really afford to pay it back. And oftentimes loans are made or taken on by companies who are not prepared for the financial reality of interest rates going up, which, to be clear, most of these loans are made on a variable rate basis or will eventually be refinanced out. And so in addition to the pension funds, I think there's been this renewed concern, too, about, okay, who did they loan the money to? And software companies seems to be a big answer here, all of whom have been under pressure for other reasons. So the question that I keep wondering about is who does this matter to? And I think my general answer is, there's some insurers, pension funds who might be under pressure if this is as ugly as some have insinuated. There are some borrowers in the software space that, could be affected if it's pretty ugly. But overall, the concern that I have more than anything else is if scares from the private credit industry lead to lenders making it more difficult to borrow, overall, that's just not great conditions for a growing economy. If it's tougher to find borrowed money, then that kind of affects everything, does it not?
Well, there's a lot of these managers have a lot of dry powder, so I don't think they're not. Dry powder is the industry way of saying a lot of funds, pension funds, and stuff like that
cash.
Have committed big amounts, so they've got hundreds of billions of dollars in so-called dry powder ready to commit to deals when they find something that meets their requirements. Look, I don't know if it coincides with a slowing economy, geopolitical uncertainty like we're dealing with right now. You could get this sort of confluence of malign forces that brings about a really big economic disruption. I just don't know, Mike, what to make of it.
A lot was made last week about Jack Dorsey and his company Block planning to slash 40% of his employees, or over 4,000 people. Obviously, as this story has been playing out and getting a lot of attention, people have dug in a little bit more and done a little bit more research on what that's all meant. So a few things. One, they did go on a big hiring spree during the pandemic. Their headcount grew from about 4,000 people in late 2020 to nearly 13,000 by late 2023. So I think that is some hugely important context that I was personally not aware of last week when this story broke. Was, okay, so you're cutting 4,000 jobs, but your headcount grew by 9,000 people over the course of 3 years. Okay, that's interesting to me. The less interesting but kind of entertaining and kind of sad piece of this is that in September, just September of 2025, the company gathered 8,000 of their employees from around the globe in California for a 16th birthday celebration for the company. They flew everybody out to the Oakland Coliseum. They hired a expensive DJ. They had the Block founder Jack Dorsey interview Jay-Z, who's a board member. And long story short, the event cost the company some $60 million to throw. And then, lo and behold, some 5 months later, they're laying off some 4,000 of those employees, many of which probably attended this event. And again, one is not directly related to the other. They're not laying off because they spent too much money on one of these events. But it sure would leave a bad taste in my mouth if I were invited to an event in California where I saw my CEO, decked out and interviewing Jay-Z, and then get a pink slip a few months later. Let's take a quick break. Markets improving as we close in on the noon hour here. We'll have a full market recap next with Wall Street Watch.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Lori Trahan are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
If you're ready for a getaway that feels easy, relaxed, and completely refreshing, it's time to discover the U.S. Virgin Islands. This is your invitation to fall naturally in rhythm with the heartbeat of the islands, where the water is warm, the breezes are gentle, and every day moves at just the right pace. Getting there is simple. There's no money to exchange and no passport required. Just pack your bags and go. Right now, experience St. Croix's special promotion, a vibe like no other. You may be eligible for a $250 per person airfare credit when you book through participating hotels using promo code VIBE2026. Imagine spending your days exploring historic towns, relaxing on beautiful beaches, and soaking in the unique culture that makes St. Croix truly one of a kind. Book between now and June 30th for travel through August 30th and start planning your escape to America's Caribbean today. Explore St. Croix's vibe like no other as part of America's Caribbean paradise. Learn more at visitusvi.com and plan your trip using code VIBE2026. That's visitusvi.com. CushingandDolan.com. Life estates are sometimes used to protect your home as part of your future, but it's important to understand how they really work before making any changes to your estate plan. Cushing and Dolan are experts in elder law and taxation. Their new guide, called Calculating the Consequences of Life Estates, explains the pros and cons and why careful planning is so critical. A life estate can allow you to remain in your home while transferring future ownership. But decisions like putting the property in your children's names versus using a trust can have very different consequences when it comes to taxes, control, and protection from creditors. Before you sign any deed or transfer property, be sure you understand your options. Call Cushing and Dolan at 866-848-5699 and ask for your free guide today. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing and Dolan. Cushing and Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hey, this is Mike Armstrong and Paul Lane from the Armstrong Advisory Group, and we're here to talk to you about our brand new guide, Divorce and Your Financial Plan. Paul, let's fast forward here a moment. You're through the divorce process, and now you are focused on this entirely new financial life. What do you view as the first step toward developing that new financial plan as you're thinking about a single individual versus a married couple?
What you really have to focus on, Mike, is the cash flows of your household. You've gone from presumably 2 incomes down to 1 income, or you're just living off of a lesser income. So understanding what your expenses are going to be going forward and matching that to the income that's coming in to your newly formed household is really important. That is something that is a area of significant focus, as well as health insurance coverage is another area that is of significant importance.
How are things like taxes and general expenses, how does that all change now if you're thinking about a single person versus a married couple?
Yeah, the tax brackets will change for a single filer versus a married couple, usually to the downside. Really, you're going to pay more in the way of taxes. So that's something that's really important to focus on, as well as many other areas of your financial plan.
Folks, we've got a brand new guide, again, from the Armstrong Advisory Group. It's free, and it's available at armstrongadvisory.com. You can request it there. It's Divorce and Your Financial Plan. There is a lot that goes into rebuilding your financial life after a life event as consequential as a legal divorce. If you have questions about how to navigate that process, this new free guide from the Armstrong Advisory Group is a great starting point. You can get it by requesting it again at armstrongadvisory.com or calling us at 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Well, equity markets are selling off, but not as bad as an hour ago, as investors are growing more concerned that the conflict with the U.S. and Iran could last longer than anticipated. Oil prices are jumping higher as a result. Right now, the Dow is down 1.8% or 891 points. S&P 500 down 1.6% or 114 points. NASDAQ selling off 1.7% or 403 points lower. Russell 2000 down 2.6%. 10-year Treasury yield up 1 basis point at 4.067%, and crude oil jumping 8% higher, trading just above $77 a barrel. Target beat earnings expectations but posted lower profit for the holiday quarter, marking its 13th straight quarter of declining sales. New CEO Michael Fidelki teased the retailer's turnaround will be presented shortly. Target shares are rising by 5%. Sticking with retail, where Best Buy's quarterly sales and outlook disappointed, but its adjusted per-share earnings came in strong, sending shares up by 4%. Meanwhile, shares in social media platform Pinterest jumping 7% after Elliott Investment Management made a $1 billion investment where Pinterest plans to use the money to buy back stock as part of a $3.5 billion share repurchase program. Elsewhere, database company MongoDB offered a soft quarterly guidance, fueling concerns that AI could upend its business. Shares are tanking by 21%, and Swiss sneaker maker On Holding seeing its stock tumble 11% after the company's annual sales guidance underwhelmed investors. I'm Tucker Silva, and that is Wall Street Watch. And the previous segment, we asked you the trivia question. Where the hell is it? How many Americans have walked on the moon? That'll be 12. 12. Yeah, John from South Hadley, Mass. is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to John, and we play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
CNBC has a piece today. Poor coordination can cost couples an average $14,000 in retirement. Wealth research finds. And they talk about a few things here, but definitely something that I've encountered firsthand. And the difficulty here is when it comes to couples coordinating their paychecks and coordinating their finances. And frankly, I've seen a lot of different ways of doing this, even with couples that have been married for decades in terms of their comfortability with it. Oftentimes, frequently, I have continue to see even couples in retirement where, John's Social Security check goes into John's bank account and Wendy's Social Security check goes into Wendy's bank account, and then they pay for some things out of a joint account, even at that stage of marriage. And so everybody has a different approach to this. But what CNBC does correctly point out in all of this is that when you take that approach, when you do not coordinate, especially during your income earnings years, you can leave money on the table. So simplest version of this would be, hey, we want to retire. We want to save for retirement. And we each have 401ks through work. And Wendy's 401k offers a 10% match. John, did I say John in this hypothetical? Okay. John's 401k offers a 5% match. But you know what? We can't afford to save 10% of our income. So we're both saving 7.5%. Great, but you're leaving money on the table in that scenario. Very obviously, right? You have a 10% potential match. You're not saving all of it into there, and so you're leaving money on the table. The more intelligent thing to do is put 10% into John's, 5% into Wendy's if you both earn the same amount. Maximize both matches, and you'll get more total dollars into the 401k, which, guess what? For most everybody, doesn't really matter if the 401k is in John's name or Wendy's name. If you get divorced or something happens, you're getting half.
So
anyway.
wait, a simple way to do that would be identify the one with the more generous match, make sure you're getting that, and then you fill the remaining person's 401k contribution limit bucket with whatever's left after that, right? Like you want to go to the max match first and make sure you're maxing out, right?
Yeah, but then it gets more complicated. What if it's the same match, but one of the 401ks sucks? I put that plainly, but I've seen
it would have to stink pretty bad for you to avoid contributing to it. Like how?
Agreed. You'd have to.
You could just all right. I'm just going to use the index fund in yours because everything else stinks, and then we're going to use offsetting investments in mine.
Yeah, and 401ks. This is less common, but I'd see it oftentimes in 403bs or options for teachers where the retirement plans are pretty ugly in some cases.
Okay. Now I see.
And so let's imagine that there isn't a match differential, but really one of these is much better than the other and has far higher costs than the other one.
Good point.
Do I really feel comfortable having all of vast majority of my paycheck going into this 401k and effectively working for maybe my health insurance benefits and not much of a paycheck? Like psychologically, it is really challenging in that case. Up until very recently, the other thing that was very common would be one of the employer plans has a Roth option, the other doesn't. Oh, which one should we be contributing to? Oh, yours has a Roth, mine doesn't. Do we, funnel more of our combined income into one versus another? Here's ultimately where I go with this. It's usually not enough of a justification to tell somebody that they have to combine their finances at this stage and really think as a married couple in terms of how to contribute to retirement. Usually, the differential in match and cost to the 401k is not so severe in those cases that it's worth completely upending how you manage your finances if you're comfortable with it, because it does oftentimes lead to discomfort, right? I mean, I know somebody in particular who just has a great option with the 401k, is working part-time, and basically doesn't take home a paycheck even though they're working 30 some odd hours a week in order to just maximize that 401k match. And it kind of sucks. Right? Just sorry to toss around that term loosely, but psychologically going to work and then not really taking home a paycheck because all of it's going towards retirement is tough to do. But you do have to understand that these plans, especially for married couples, are designed in ways where there can be advantages and disadvantages to contributing to certain types of plans, to certain types of contributions. Maybe your employer has an option for putting company stock into the 401k. These things do get complicated. And while it's fairly simple in terms of what you should do as a single individual, when you add a partner in there, when you add kids into the equation, it becomes immensely more complicated in terms of how you position your retirement savings. If you're in that position, you've combined finances, you're trying to figure out, hey, what's the best way to maximize all of my benefits for my family's future? Give the folks at Armstrong a call. This is the type of stuff that we focus on with our clients every day. You can reach us at 800-393-4001. We offer free consultations throughout New England. The number again, 800-393-4001, or you can check us out and book a time for us to call you back at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Well, we had tariffs. Then briefly we didn't have tariffs when the Supreme Court ruled them out. And now we have tariffs again. And businesses of all size are trying to figure out what the heck they do about it. So to be clear, if you are Walmart and Target and TJ Maxx and Costco, you've had your legal team lined up for months, prepared for the Supreme Court to throw all this out and start suing for your refunds. What's a fair bit more interesting is what you're doing if you are a 50-person company that manufactures that sells clothing in the United States, and you paid $1 million in tariffs over the last years. You have to really measure, okay, how much am I going to spend on attorneys? If I get the money back, what time frame is it going to be returned to me? What if I don't have the cash on hand to hire an attorney that specializes in this? Because guess what? They're probably pretty expensive right now, given how few of them know what they're doing. Do I need to borrow money to go get that? If I do get the tariff refund, will my customers be expecting money back from them? I was listening to an interview with somebody who hadn't decided yet if they are going to sue the government over these tariff refunds because they were evaluating all of this, combined with the fact that they actually had to borrow money to pay the tariffs in the first place. And they're sitting there saying, okay, I have to borrow more money to hire the attorney. I borrowed money to pay the tariffs. My customers, if I get a refund, might want some of that back. But in the meantime, I got to pay all this interest that I just paid on the tariffs that were deemed illegal. It is a really clear answer of what to do if you're Costco. If you are that small business, it's some really funky math right now. And I don't really have any advice for those people that are in that position. It is a tough position to be in. And right now the government has not done the right thing to do would be make a very clear process for those small businesses so they don't have to hire a law firm for $500,000 or whatever it's going to be in order to process this stuff.
Yeah.
But to this point, there's been nothing on that.
All those regulations they've cut, and they deserve credit, the administration does, for wanting to reduce the burden on business. Some of those regulations have benefits as well as costs, so I'm being a little sloppy here. But generally speaking, we could probably afford to cut half of the regulations we impose on the private sector. I know that's a little bit cavalier, but I suspect it's not too far off. All that is undone by this reckless tariff policy. This refund turmoil could have been avoided had these tariffs been. Now, I don't like them, but if Congress had voted on them, made them law, I couldn't complain about the process. Instead, this haphazard tariff by proclamation, on again, off again, whatever you want to call it, process it wasn't a process. It was just whimsical. We went this way for a year. People warned that it wasn't sustainable, that it was likely to face successful legal challenges. The administration did it anyway. My point is, in making reference to otherwise good regulatory burden reduction moves, is that this offsets all that, Mike.
Yeah.
That now we're all spinning our wheels. They're wasting resources on attorneys who haven't had a client in 30 years because they specialize in tariff law and nobody needed them. Now all of a sudden they're the belle of the ball. Great. think about the tragic waste of resources. That is, instead of developing new products, finding new ways to make customers' lives better, they sit around thinking about tariffs, tariff refunds, and what the future holds for tariffs. It's a tremendous waste of time, money, and resources. It offsets tax cuts and other regulation cuts.
That's the one piece that I think can get bipartisan support is nobody's terribly happy that a bunch of lawyers are going to make a whole bunch of money on this. And that's one thing that is almost definitely certain is lawyers are getting paid after all of this Supreme Court action.
Yeah, cottage industries always crop up when government missteps. And this is another
financial
example
services too, by the way, because a bunch of
Sure.
financial services companies are going to businesses, small ones in particular, and saying, hey, we think you're owed $1 million in tariffs. Sign over the rights to that revenue for $300,000, and we'll do all of it for you.
Even if you love tariffs, it was just such a misguided way to implement them, totally unavoidable.
Quick break. When we return, bit of stack roulette is next on the Financial Exchange.
Follow the Financial Exchange on Instagram for market insight, clips, reels, and daily money talk. This is the Financial Exchange Radio Network. Many families consider using a life estate as part of their planning, but without a clear understanding, it can lead to unintended consequences. Cushing & Dolan have a new guide called Calculating the Consequences of Life Estates that explains what to watch for and how to think through your options before making any decisions. Key rules to be aware of include the 5-year Medicaid lookback, where the state reviews financial transactions over the prior 5 years, and certain transfers, like giving away property or assets, can create a period where benefits are delayed. Call Cushing & Dolan at 866-848-5699 to request your free guide today. That's 866-848-5699. Or request the guide online by visiting our website, legalexchangeshow.com. That's legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. If you're ready for a getaway that feels easy, relaxed, and completely refreshing, it's time to discover the U.S. Virgin Islands. This is your invitation to fall naturally in rhythm with the heartbeat of the islands, where the water is warm, the breezes are gentle, and every day moves at just the right pace. Getting there is simple. There's no money to exchange and no passport required. Just pack your bags and go. Right now, experience St. Croix's special promotion, a vibe like no other. You may be eligible for a $250 per person airfare credit when you book through participating hotels using promo code VIBE2026. Imagine spending your days exploring historic towns, relaxing on beautiful beaches, and soaking in the unique culture that makes St. Croix truly one of a kind. Book between now and June 30th for travel through August 30th and start planning your escape to America's Caribbean today. Explore St. Croix's vibe like no other as part of America's Caribbean paradise. Learn more at visitusvi.com and plan your trip using code VIBE2026. That's visitusvi.com. As you navigate life after divorce, planning for your family's future becomes even more important. Hi, this is Mike Armstrong from the Armstrong Advisory Group. From everyday expenses to thinking about how college will be funded, it's important to have a clear plan for how all of your upcoming costs will be handled over time. Divorce also means adjusting to a new financial reality, where one household becomes two and your budget, saving strategy, and long-term goals may need to be reevaluated. Our new guide is called Divorce and Your Financial Plan, and it discusses ways to build a financial strategy that supports your family's next chapter. You can get your free guide today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com. The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Subscribe now to our YouTube page, where you'll find daily interviews and full shows of the Financial Exchange. We'll get you caught up on anything and everything you might have missed, right here on the Financial Exchange.
The Financial Exchange is proud to be a partner of the Disabled American Veterans Department of Massachusetts. Planning is well underway for the 2026 DAV 5K. The event sold out in record time last year, so head to dav5k.boston for all the information about how you can participate this November or make a donation to support our great American heroes. Your gifts help fund free rides to medical appointments for veterans and the nation's first DAV-led housing initiative providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today. That's dav5k.boston.
We're approaching the noon hour here in the U.S., but European markets are starting to close over there. Generally speaking, markets in Europe down about 3% on the day as the tension in the Middle East continues to intensify. Here in the U.S., though, we've made up a lot of ground. The S&P 500 at one point today was off about 2.3%, now down only 1.4%. The Dow, which when we opened I think was off about 1,100 points, is now off 716 points, or about a 1.5%, and the NASDAQ down 317 points, or 1.4%. So obviously quite volatile out there in equities, both domestically and abroad, and we will just have to continue to monitor here as investors digest.
Yeah, if you want to play that what are markets telling us game, it seems like the stock market is saying, we don't know how long this is going to last or how severe the economic impact will be. That makes sense.
Sure.
Bond markets, well, we know that U.S. Treasury notes and bonds and bills sold off over the past couple of days. So yields have gone up. Interest rates have gone up.
Yeah.
That makes sense, too, I think. A rise in oil prices, even if it's not sustained, will have a short-term impact on inflation. That sort of ties the Fed's hands.
Yeah, I think that's the conclusion, right? It doesn't mean we're going to get much higher inflation over the next decade, but an event like this makes it more difficult for the Fed to control inflation and bring down interest rates.
I haven't seen any evidence yet that the real part of longer-term interest rates, because you could break them up into expected inflation and the real component, are going up, because this means more government spending, say on defense, bigger deficits, upward pressure on rates. That may come down the road. Probably too early, because you can't tease. Short-term rate movements are probably real rate movements, generally speaking. But the rise in oil complicates the picture. And then finally, metals. Gold rallied yesterday, pulling back today, though. My little story yesterday was, well, it's a safe haven asset. People flock toward it. But that doesn't jive with what's happening today. People are not flocking toward anything but the U.S. dollar, which is up. What are they buying with those dollars? It appears nothing in terms of U.S. assets. They're just parking them in bank accounts. But the U.S. dollar, still the world's reserve currency and still the trusted unit of exchange. You know, if you need something liquid, you're going to pay. If you want a liquid currency that just about anybody will accept, you're going to use U.S. dollars. Clearly, dollar is a beneficiary.
By the way, just flashing across the TV right now, diesel prices have jumped by a record 34% in 2 days here. So we were talking about gas prices and other prices, diesel prices moving massively over the course of the last 2 days. That is apparently a record for a 2-day price
and that's one very vivid example of how this type of thing can make its way into the prices of other stuff.
No kidding, right? Yeah.
Right, you were talking about that earlier.
Right into your 18-wheeler. Anything else catching your eyes in terms of markets or stories this morning, Mark?
I'm not very good at this part of the program, as you know, Mike, to begin with, but today everything is war related. So it's hard to see, other than Apple raising its prices 10% on MacBooks and stuff like that, they blame chip shortages, which is plausible.
Specifically RAM, I think, is
that's
a big
what.
issue right
active
here.
memory chip. They're blaming that, and then to the extent that this is a universal problem, not helpful for inflation, but I don't want to start crying wolf about relative price changes either.
Yeah, I think the narrative on anything tech-related right now in terms of, frankly, a lot of different parts of the economy has been for the last couple of years that the artificial intelligence industry is eating up a lot of resources.
Undeniable, right?
Whether it's literally
black hole,
whether it's literal labor to construct data centers or electricity, or now the big story being memory, RAM, going into all sorts of devices. All of it is being bid up because of the boom in artificial intelligence, and we're starting to see some of the impacts of that, and one of those is through Apple products that need to be priced higher because of the cost of some of these
This
inputs.
has to affect the rest of the industry. I mean, if they're lying, we'll find out, because others won't respond similarly, right?
Dow Jones, Industrial Average, S&P, and NASDAQ all strongly in the negative here, over 1% down as we close out the show. Russell 2000 down 2.5%. Oil prices as we close out up 5.36%, but even that has moderated off of its earlier highs. We'll be back at it tomorrow with a full recap and more here on the Financial Exchange.